everybody. Welcome to the 2-week warning. I almost said 2-minute warning, but it is the 2-week warning. We officially have less than 2 weeks remaining for Dream for All. I am super excited. This is something that I was excited about last year, built the excitement over the last 12 months, and now here we are. We are in the home stretch, and I've got a lot of really exciting things to talk to you guys about today. So if you're watching live, feel free to post questions. If you're watching recorded, post the questions and I'll get to them later. But I'm going to cover a lot of things today. So I'm going to cover big picture of what is Dream for All. So I'm going to cover that. We're going to talk about what things have to happen in the next 2 weeks and what you can expect from me in helping to get you across the finish line. We're going to talk about a big issue, which is interest rates and how are interest rates going to impact your approval amount on Dream for All. So that is something really important we're going to spend some time talking about tonight. We're going to talk about what do you do now that you've registered. So you've completed your registration and now you've got to figure out what are the next steps and what do I do from here. And so we're going to talk about that. And then we're going to talk about picking a real estate agent. What things do you need to do to pick a realtor? How does that process work? So I'm going to explain that to you. We're going to talk about who pays for your real estate agent. We're going to talk about when you should start shopping for homes. And we're going to wrap up with what can go wrong between now and when I get my voucher. So lots of stuff we're going to pack in tonight. Looking forward to having a really informative discussion. So if you have questions about anything, feel free to post it. Again, I've got people from probably 7 or 8 different streams on different platforms. And so if you are watching on any of those platforms live, feel free to post questions. If you're watching recorded, then feel free to ask me questions and whatever platform you're on, and I'll get back to you later. So let's go ahead and dive in. So first of all, what is Dream for All? Dream for All is a shared appreciation loan. You are getting in partnership with the state of California. You are agreeing that I am going to get 20%. You are getting 20% up to $150,000 from the state of California. And in exchange for that assistance, they are getting that percentage of the growth in the value of your home. Now, I've had a lot of people recently misunderstanding how repayment works. Excuse me. And they've said, John, if I repay the state back the original $150,000 that I got from them, then when do I have to pay back the appreciation? You are never going to pay a penny to the state until you're ready to pay all of it. There is no good reason to ever pay a penny to the state until you're ready to pay all of it. Now, I had somebody ask me today when we were talking about strategy. We were talking about, hey, should I pay back the state if I come into some money or should I not? And the question is, what's the next best use of that money? If that money's literally going to sit in an account making you next to nothing, then obviously you should pay back the state. You should get rid of the estate, sharing in your appreciation as quickly as possible. But if you could take that money and put it towards another investment, maybe it's building a business, maybe it's buying investment properties, maybe it's paying off high interest rate debts. We've got to look at not just should I pay back the state as soon as I have the money, but what else could I do with that money instead? I'm not telling you that you should keep this loan with the state as long as possible. But I'm telling you, you shouldn't automatically assume that the best plan is to pay them back as quickly as possible. It is about your long-term and short-term plans and how paying back the state impacts those plans. So again, brief overview of the program, as I've already said, excuse me, you are getting up to 20% of the purchase price, up to $150,000. You're paying back the state when? This is something that a lot of people have misunderstood and asked me more questions, so I'll repeat it again. You pay back the state when you refinance. Now, there's an asterisk next to the refinance thing, but let's set the asterisk aside for a second. When you refinance, you pay back the state. Now, you can refinance and pull extra cash out to pay the state back. You don't have to write a check out of your pocket. You can wrap it into your loan as long as the value's gone up enough that you have enough equity to make that happen. Okay, so you can wrap it into your loan, or you can pay it out of pocket. But the next time you have to pay back the state is when you sell the home or in 30 years when you finish paying off the primary mortgage. The state will always get their original back, and they'll always get the 20% of whatever the appreciation has been. So that you will always pay to them. Now, who qualifies? You qualify if you are a first-time home buyer. Everybody on the loan has to be a first-time home buyer, which means you have not lived in a home owned by you or your spouse anytime in the last 3 years. And then one person on the loan has to be a first-generation home buyer. Excuse me, guys. One person has to be a first-generation home buyer. So what does first-generation mean? It means that you have had nothing to do with a mortgage for 7 years, and your parents do not currently own a home, or if they're deceased, they didn't own a home on the day you died. Now, so many people are asking, John, I just learned about this program and I just don't understand. Why is that a rule? I don't get it. It seems unfair. First of all, them's the rules. And he who has the money sets the rules. The state of California legislature set aside the money. They get to set the rules. Their thinking is there's a subset of society that in general is homeowners. Your parents have been homeowners, your grandparents have been homeowners, and you're a homeowner. And then there's a subset of society that has never gotten out of being renters. And they're trying to change that for that subset. Now, I will tell you that there were challenges back in the early 2000s that led to some of the problems we dealt with in the Great Recession. And those challenges came from the Clinton and Bush administrations, both of them, pushing the home ownership rate up. And they said, being a homeowner, that is way better than being a renter. Homeowners have way more wealth than renters do, and they're right. The problem is they pushed the home ownership rate up by saying, hey, I think it's 62% of the American population owns a home, and they wanted to get that higher. And they got it to like 67%. So it was only like a 5% difference. But they had to get too creative in finding ways to get those people into homes. And it was creative in the ways of not looking at their income or not looking at their assets or not proving they have the money to pay back the mortgage, and the market crashed. And I'm not telling you we're headed for a market crash. I'm just telling you that the market itself is fragile. And that the more we do to try and change the market, the more challenges we sometimes run into. I don't think this program is one of those, but I do think that the government trying to manipulate a particular segment can create some unintended consequences. In this case, I think this is one that overall is really, really good. I just want to really be clear that there's some very polarizing feelings out there about why it's fair or unfair. The fact of the matter is, legislature created the program and they get to decide who gets access to the money. Okay, so that is the Dream for All program. It is limited in money. There's only so much money to go around. So between 1,700 and 2,000 people will be able to have access to the money. And it's geographically driven. It's based upon where you live right now. You're put into a pool based on the population of that region. And I have my numbers right here. So I'm going to quickly remind you of this. Let's put this up here. And let's share this thing right here. So let's go share my screen. And I want to share that entire screen right there. And we'll hit share. And beautiful. All right. So this is a reminder of how we look at the numbers. And so basically, it's based on the percentage of the population in the region that you currently live in. That's the percentage of the money that that region gets. So the Bay Area is 19%. Last year they got 19% of the money, but they're 21% of the state's population. So they get 350 to 420. These are the counties that are in the Bay Area. By the way, if you need this chart, you can get it by going and downloading a copy of my book. All of this is in the book. If you don't have it already, here's the link to the book. Why are you not coming up? There you go. There's a link to the book. So the program is based on where you live today, but you can use that money to buy anywhere in the states. Now, let me make this, let me adjust this size, make me a little bigger, make this a little smaller. Let's see if that works. Okay, cool. So again, I'm covering tonight, by the way, the things that people have brought up that are questions that I keep getting over and over again. You are not limited to buy in the county you live in today. The only thing that matters about the county you live in today is what pool you're put into. So if you look at it, people would say, oh my gosh, I'm in the rural area. That's not fair because I'm only getting 4% of the money. But only 4% of the state's population lives in all of these counties combined. So sure, you're getting a small percentage of the money, but you're also a small percentage of the population. The biggest winner from when it comes to percentage is Los Angeles. 25% of the population lives in Los Angeles County. That means Los Angeles gets between 425 and 500 of the vouchers. Now, there's going to be an equal number of wait listers. So when you get your voucher response, you're going to get one of three responses. You're either on the list, you got a voucher, you're on the waiting list, or you didn't get selected. Okay. If you didn't get selected, that's what we're going to talk about, what your other options are. Now, I'm not going to push you to become a homeowner, but I want to explain to you what your choices are. We've already ripped off the Band-Aid. We've already looked at your income. We've already looked at your assets and your credit. And so now let's strategize. And so what's going to happen is people are going to start hearing about their vouchers. My best guess, late May to early June. In the meantime, I'm going to continue doing regular videos that I'm going to put on my YouTube channel that are going to give you information that you need, similar to what you're going to get from me tonight about the home buying process. And if you're selected, the first thing we're going to do, and let me go over here really quickly. Hold on. Okay, so the first thing we're going to do if you're selected is we're going to have a strategy meeting immediately with you and your real estate agent. Okay, and part of what we're going to talk about in a couple minutes is how do you pick a real estate agent. But we're going to have a strategy meeting with you and your realtor. You need to start searching for a real estate agent. So you need to kind of start the process of saying, hey, who do I want to use for a realtor? And it's really critical that you find somebody that you can trust, because your realtor has to guide you through this process. It is not only is it about your realtor understanding the market, your realtor has to understand the program and how Dream for All works, and I will help educate them. But your realtor also has to understand how to get your offer accepted in a highly competitive market. And that's really critical, because all up and down California, we're in a competitive market. Now, as interest rates go up and down, you'll see when rates go up, it's not as competitive. When rates go down, it's way more competitive, but your realtor needs to be able to guide you, and you need to be able to trust your realtor on, should I write an offer on this home at the list price? Should I write it less than the list price? Do I have to go over the list price? And you've got to really be able to trust their opinion, because you're only going to have a limited window. We've been told it's 90 days and that you're able to ask for an extra 90 days, but we don't know what criteria CalHFA is going to use on whether everybody's granted an extra 90 days or only under certain circumstances. So I don't want to take the chance and say, hey, you have 6 months, because it might be only if, like, you wrote an offer and then it got rejected, or you wrote an offer and we're in contract and you canceled. Maybe that's the only time they're going to let you extend. I don't know. They haven't given me an answer, and I've tried to get an answer on that. So it's really, really important to understand urgency is critical. You don't want to have buyer's remorse. So you want to start getting a feel right now. You want to start getting a feel for, what does the market look like? What areas should I be buying in? What should I consider as far as school districts? What should I consider as far as amenities that I want within the area? And what concessions am I willing to make? Concessions are critical, and it sucks. It sucks to not have everything I want. I wish that I could have my cake and I could eat it too and keep this girlish figure. None of those things are true. So I understand, and you need to understand, that this process of buying a home, especially when you have a limited time to succeed in getting an offer accepted, is going to require some preparation, some work in advance. Okay. So you want to pick a real estate agent who you can trust to guide you through that process. And we're going to work as a team between the three of us, you, me, and your realtor, to help guide you through the process. And you want to start early in getting on their drip campaign, finding out what's out there. And it's not just a matter of, oh, I can find everything on Zillow. Okay. There's a lot more to it, and realtors help you navigate what the unknowns are as much as they help you navigate the knowns. Now, one of the questions I've gotten a fair amount, especially in light of some of the news media you've read recently, is who pays for the realtor? So here's the deal. There was a lawsuit. There's a lawsuit that started years and years ago, a long, long time ago in a galaxy far, far away, not so long ago and not so far away. There have been multiple lawsuits that attorneys were gathering up home buyers and sellers to sue real estate agents for saying, you guys were unfair because you forced sellers to pay for the agent that represents the buyer. And the real estate industry lost. those lawsuits. At least one major one they lost, and they've settled most of them, or in the process of settling them. And one of the biggest changes is that starting this summer, mid-July is what the expected date is, that a buyer has to sign an agreement with their agent before they go view a property, saying how much you as a buyer are going to pay your realtor. Now, historically, listing agents have negotiated with the seller, and they've said, hey, somewhere between 4 and 6% on average is how much the average commission has been to the seller paid. And that was normally split 50-50 between the agent that represented the seller and whoever brought the buyer. And so you as a buyer didn't have to write the check as part of your closing costs. It was for sure part of the price of the home, part of the strategy on the side of the seller. It was part of the transaction, but you didn't have to write the check. Well, now that the rules are changing, a lot of people worry, do I have to pay my realtor? Do I have to come up with an extra 3% out of the purchase price of the home? Or 2% or 2.5% or whatever the number is to pay for my real estate agent? Not necessarily. All it says is you have to agree with your realtor what they're worth to you, and then you can negotiate to ask the seller to pay that. Here's the challenge. The challenge is that somebody might have negotiated with their realtor to say, hey, I'll pay you this dollar amount, and I have such a big amount of money in my bank account, and I want this house so badly that I'm willing to pay your commission. You don't need to ask the seller to pay it. That puts you at a disadvantage because you're asking the seller, you're asking the seller to pay that amount to pay for your real estate agent. And if you're offering the exact same dollar amount as somebody else is, and that person isn't requiring the seller to pay for their realtor, their offer is better. It nets more money to the seller. And as a seller of a home, that's what you're looking for, is the smoothest transaction that nets the most amount of money. And so it's critical to understand that as we look at how to make your offer look better. And those are the strategies we're going to go through, is to figure out, hey, what's the market like? Are we seeing in that particular community a lot of offers being written where sellers are not being asked to pay their buyer's agent's commission? And how do we address that? Can we wrap that into your closing costs? In some cases, yes, and in some cases, no. So we've got to figure out how this is going to play out. But it's critical that we have these conversations early and that we explore all of these circumstances, because your key is you've got to find a home and a seller that is willing to accept your offer within the limited amount of time that you have to use your voucher. And again, you only have so much inventory to go around. So you're not going to be able to be too picky. So you got to make sure you know what you're looking for. You got to make sure you know where your focus is on what you want to buy and what you're willing to spend and where you're willing to make concessions. Okay. All right. So let's talk about when should we start shopping for homes? So I kind of already talked about this a little bit, but I want to be more clear. You need to start shopping for homes now, but you're not writing offers. You're not going and visiting a bunch of homes. And let's also be clear. Your real estate agent does not get paid for driving you around every weekend to look at homes. They're paid for helping you complete a transaction, and that includes driving you around to look at homes. But it isn't really fair to ask them to work for free every weekend for you when you can't buy it until who knows when. So when you engage the services of a realtor, your goal is to spend time with them like you're spending with me, on the phone, talking about scenarios, figuring out strategy, but you're not going much beyond that. They're sending you information. They're exposing you to markets. They're getting a feel for what you want. And then you are going out and you're checking out open houses. You're driving around on a Saturday or a Sunday and you're checking out different neighborhoods and looking at different homes. Not that that home is going to be available when you get your voucher, but because that home represents the neighborhood. It represents what the price point is and what you get at that price point, so that you can decide, is this not what I'm willing to spend? And if so, how is that going to translate to my approval letter and what I'm looking for? Because look, the biggest thing about buying a home when it comes to price is location. The second biggest thing is location. And the third most important thing is location. That is the three most important things. So if you love a house and it's exactly what you need, but it's too much money, find a similar house further away in a location that is not in as high of demand. Or if the location is most important, you have to bring down what your expectations are on a home. All right, Billy, thank you for being here. Welcome, my friend. Guys, if you put in a comment, you get to see your name on the screen. Appreciate that, Billy. So guys, you need to start figuring out what's out there. You're shopping now. You're shopping by, yes, you're checking out Zillow. Yes, you're checking out Redfin, but you're looking at the neighborhoods. You're looking at the open houses. You're getting a feel for what the market has out there so that you can pay attention and be ready to pull the trigger once you get your voucher. All right. So let's talk about, let's go to my next thing. What do I want to talk about? I want to talk about a big one. You ready for a big topic? What's the rate impact to your pre-approval amount? This one's a really, really big deal. This is one that you all need to pay attention to because interest rates have been climbing. CalHFA's interest rate as of today, if you guys didn't look, I'm gonna take you backwards a little bit in time. Let's go here to CalHFA's website. And first of all, let's pop this back open and show you. So this is as of Friday. So this was 7:55 a.m. on Friday the 12th. CalHFA's rate had popped up to 7%. 7%. It had been as low as 6.25 to 6.5, had tickled 6.75. On Friday, it went up to 7%. Guess what? That isn't as bad as today's rate. Today's rate, 7.25. That is the rate that we expect to have. This line item that says CalHFA conventional with down payment assistance. That is the same line, matches the line that was the Dream for All number last year, and I expect it to be that. CalHFA even said so. They expect it to be the same rate as this one. So we've seen this move up even more. So for a lot of people, I and other lenders pre-approved you at whatever the rate was at that time, which was 6.25 to 6.5. And the truth is, I am still pre-approving people today at 6.5%. Now you say, John, why in the world are you doing that? Because if they would have called me a month ago, I would have given them a letter at that price. So why would I penalize them right now by saying you're qualified at a lower dollar amount when the truth is we don't know where rates are going to be? But you need to understand the impact of a lot of these things that are happening, including what is happening with interest rates, including your debts. I'll show you very quickly here. If we go back and look, I can just give you a little bit of history. And let's go back to even just early March. So I'm only going back 1 month. And it's going to download this cool report for me. We're going to pull up the report. Why didn't you pull up report? There you are. And you can see CalHFA's interest rates. You can go back, I think, 90 days, 120 days. And what you're seeing here is CalHFA. So at the top, we're starting with current rates. Let's just scooch all the way down to the bottom. And we're going pretty far down. So I'm on March 5th. And a CalHFA with down payment assistance was 6.875 on March 5th. And then if I scooch a little bit forward, we're down to, on March 8th, we dropped. We were down to 6.5%. And then we're jumping kind of forward here, and we end up on, what day is this? This is March 19th. And we're still at, oh, I'm sorry, with down payment assistance, we're at 6.625. And then we kind of jumped a little bit around, and here with down payment assistance, we're at 6.625. But the market has gone up in the last couple of weeks. And so April 2nd, we're now pushing 6.875. And then we go a little bit further into April 4th, and it is still at 6.875. And so you're seeing these numbers, and I've been watching these numbers, and we hit April 11th, we hit 7%. As a matter of fact, we hit that on April 10th. On April 9th, we were still at 6.875. So that gives you kind of an idea of the range of where rates have been in just the last month. But let's take a sobering look at what all that means. So I'm going to scooch in here, and let's see if we can see this big enough. Let me know if you can't see this big enough, and I'll make myself smaller, but I like to see a big version of me. Hopefully you do too. All right. So I'm using Los Angeles County as an example. You make $155,000 in Los Angeles County, and you have no debt, and you're putting 5% down from your own money, and you're paying your own closing costs with a credit score over 700. And so you're technically allowed to spend $6,458 a month. This is how the math works. This is how lenders approve you. It is not, I'm not approving you for a purchase price. I'm approving you for a monthly payment. So I'm taking your income divided by 12, your monthly income, And then I'm taking that number and I'm allowing you to spend 50% of it if you are over a 700 FICO score. If you are under a 700 FICO score, I'm only letting you spend 45% of that. So this allows you to see how much I would let you spend. Now, these are ballpark numbers because the taxes and insurance are technically different based upon the purchase price. So I'm averaging the numbers a little bit here because it's the only way I can make this spreadsheet work without spending hours working on it. So you say, hey, I'm going to tell you, you qualify for up to a $6,500 a month payment. Now, if you have $1,000 in credit card debt or car payments, then the truth is you only qualify for $5,458. So you say, John, how do I increase my buying power? Well, get rid of your debt is the number one thing you can do. People have said, oh, I'm so upset. I can't put extra money as a down payment on this program, and I just want to get my qualification higher, and I can do that by paying bigger down payment. You can also do that by getting rid of your debts. So lower your debts, because if you get rid of that $1,000 in debts, you now increase your purchase price. So let's look at what those numbers look like, okay? So I would let you spend, if you had $155,000 in income and $1,000 in monthly debts, I would let you spend $5,500 a month, assuming there's no HOA. So I built my spreadsheet so it even shows HOA. At a 6.5% interest rate, that's an $885,000 purchase price. Between your 5% and the $150,000 from the state, that's a $691,000 loan amount, and that equals this total monthly payment of $5,458. But rates aren't at 6.5 anymore; they're at 7.25. And so at 7.25, we've lost $53,000 in buying power. Your pre-approval letter that I gave you 30 days ago at a ballpark of 6.5. Your pre-approval letter I gave you yesterday was at a ballpark of 6.5. And yet, in today's interest rates, you're 0.75% higher. For this particular scenario, that cost you $50,000 in your buying power. $50,000 in your buying power. Now, if you have some debt to get rid of, that's great. So you can get rid of this debt, and now you can qualify for more. But you need more cash out of your pocket. So now you found a way that says, okay, if I got rid of that debt at 7.25, I can actually qualify at 955. But maybe I only need to get rid of some of that debt because I really only need to go to, $875,000 purchase price. So there's a lot to think about here. There's a lot to understand that interest rates drive your purchase price. And it's a wild difference. If you're in Orange County and Orange County says you can make $202,000 in income, that means that you could buy, again, if you have no debt, and I don't know my numbers. Yeah, here we go. So you can't go higher than about 1.29 because the highest loan amount is $1,089,000. So you couldn't do a $1.3 million purchase price. So you can kind of forget these numbers. They don't exist anyway. But at $202,000, you can go to the cap of $1.29 million in Orange County. But if rates are at 7.25, you now lost almost $100,000 of your buying power. $100,000 of your buying power because interest rates went from 6.5 to 7.25. You literally lost $82,000 of your buying power, and you cannot write a check to make that up. You cannot say, John, I'll just pay the difference in that purchase price and cover that out of pocket, because the Cal HAFA program set a cap that says the most you can put out of pocket is 5% of your own money. And so these interest rates, nobody can control, and it is going to make a big difference in your buying power. It's going to make a huge difference, even if you're in a situation where you make $85,000. And if $85,000 is an example, and let's say you're saying, John, I don't have the money to pay for my own down, 5% down, so I'm not paying that. And oops, no, let's change that to a no, John. And I don't have the money to pay for my own closing costs. So you notice as I do this, your price range drops. So right now, if you're paying your own closing costs and you made $85,000, you could buy a $560,000 home at 6.5%. But at 7.25, you're down to $519,000. Now, if you said I can't afford to pay my own closing costs either, now you're looking at $533,000 that just dropped to $494,000. And if you had under a 700 credit score, now you're looking at a $480,000 max purchase price that has dropped to $445,000. Why does this all matter? Why am I making a big deal? Am I trying to scare you about all of this? No. What I'm trying to do is I'm actually trying to explain to you what can go wrong between now and when you get a voucher. And so this screen kind of gives us a lot of the information that I need you to be paying attention to. By the way, guys, if you have any questions and you're watching live, now would be a good time to post them. I probably have about 10 more minutes of stuff that I want to cover. And if there's no Q&A, then we'll wrap it up. So if you have Q&A, now would be a great time to post that into the chat. Anything you want, all bets are off. You can ask me any question about Dream for All, about loans, about the housing market, about interest rates. I want to be a guide for you and answer whatever questions that you have. So what can go wrong? First of all, income limits. When we just look at your amount of income, your income could go up between now and then. How I calculated your income is not locked in. It is the calculation I used now. We have to rerun that calculation and compare it against the income limit when you go into contract. Now, I think we're going to see income limits go up in July. I expect we're going to see income limits go up in July. I've also expected for the last year and a half that we were going to see interest rates drop. And we haven't seen that at all. So for me to say that I have a good feel for the market, I have a good feel for the market. And it's just like your stock guy saying he's got a good feel for the market. He still can't tell you what stock's going to go up or down tomorrow. Look, it is impossible to know for sure where the market's going to go. There are too many dynamics. But I do feel, based on everything that I've seen and all of the stuff that I've read, that income limits should be going up. And I expect that CalHAF will be raising those in early July. So if you're tight and you've gone a little bit over your income limit, that would help you, but that's something that can go wrong. If your credit score falls, the credit report that we pulled is good for 4 months from the day I pulled it until the day you close escrow on the purchase. There is a good chance we have to do a new credit report. If your credit was 702 and it fell to 699, now you can only spend 45% of your income instead of 50. So this pre-approval went from 533. Well, now rates are at 7.25, so it dropped from 533 to 494. But your credit score fell, and your credit score went, which means your 533 that went to 494 really is at 445. $445,000. That is a significantly different home than the home that you thought you were pre-approved for. And so it's important to make sure that you don't have anything happen to your credit. Now, if you were under 700, work, do everything you can. Talk to me about ways you can improve your credit, because if you can get your score over 700, it stretches your buying power. Just understand, stretching your buying power also stretches your monthly payment, which brings me to the next thing that I want to really help you understand is you don't have to spend every dollar of what you're approved for. So if you make $180,000 a year, and you have no debt, I'll let you spend $6,750 on a house payment. But most people are like, John, I don't need a house of $950,000 or $900,000. I'd kind of be okay with a payment of around $5,000 a month, please. And that's great. And so my handy dandy calculator that I can work with you on, we can look at that and say, hey, $5,000 a month, you're looking at between $750 down to maybe $700 based upon where interest rates are. That's the range. And so if you want to qualify with a payment of $5,000 a month, you'd be shopping somewhere between $680, $690 at the low end and $750 to $760 at the high end, just based on the range of where we've seen interest rates go. And so it's really, really critical to understand that. Here's the other things you have to pay attention to. Homeowners association. Most of the time, your homeowners association comes into play when you're buying a condo or a townhome. But sometimes you even have single family homes that have a homeowners association of, $250 a year. Well, guess what? $250 a year is still money. It's still $20 a month-ish. So you've got $20 a month that you're paying. It lowers your buying power. But if you're buying in a condo and that condo has a $600 homeowners association, your buying power just went down significantly. So here in this situation, you didn't want to spend more than $5,000 a month. But we've got to allocate $600 for your homeowners association dues. And so without that $600, you were qualified, let's just call it at 7%, you were qualified at $715. But we add that $600 homeowners association, that $715 goes to $630. Yeah, we're talking about $85,000 drop for $600 a month in a homeowners association. So if you're saying, I want to buy in Los Angeles and I make $135,000 a year. And so I can really only spend about $5,000 a month. And I got, $500 a month in credit card debts or car payments. So I'm looking at, a $570 to $599 purchase price. John, I can't find that in LA. Maybe I can, but it's going to have to be actually, let's do this the other way. Without the HOA, you're looking at, $650 to $680, $690 in a purchase price. And you're saying, okay, I could do that. I could find a condo at that price range, and it'd be a pretty decent condo, but it didn't factor for an HOA. And so once you factor in the HOA of $600 a month, that $650 to $680 you thought you were going to be buying is really $560 to $590. Now it's like, wait a second. I thought I could get a decent condo for that price, but you just lowered my price because we didn't talk about it being a condo, which is why you have to start looking right now with a realtor to figure out, am I looking at single family homes? Am I looking at townhomes? Am I looking at condos? This program can be used for manufactured homes that are on a permanent foundation on land that you own. So are you looking at that? We have to understand the property type to make sure that we are targeting the right property at the right price. Here's the other thing you have to think about. You got to think about insurance. Now, homeowners insurance is included. So I've estimated for taxes and insurance. But insurance, by the way, I'll talk about taxes in a second. Insurance, you're looking at an insurance market in California that is falling apart. Okay, I'm sorry to say this. If you didn't know it, you're about to become a homeowner. Congratulations. Good luck in getting insurance. I'm only saying that as a partial joke. Okay. I've heard some insurance carriers aren't insuring homes that have a roof that is over 20 years old. I've heard stories about the things that insurance carriers are looking for because insurance companies have lost so much money in the state of California. Why? Well, because the Department of Insurance hasn't let them raise insurance rates. And you think, well, that's a good thing. That's helped us keep insurance prices down. But it's a death spiral. Because what happens is companies like State Farm say, fine, I'm no longer doing new policies in the state of California. You won't let me raise my rates to cover what I'm paying out in fees. Now, why are they paying so much in fees? Because of all the money they've lost on homes that have been damaged or destroyed in wildfires. There's been some major problems with major wildfires. And we saw in Lahaina, Hawaii last year, year and a half ago, that it was devastated by a wildfire. Okay. Insurance companies can't absorb that big of a loss. They have to raise their premiums. They can't. So State Farm said, I'm out. I am no longer doing any insurance policies in the state of California. I'll keep my existing clients, but we're not doing any new ones. And other companies have followed suit. And so you're buying a home and you've got to find insurance. And if you're in a low fire risk area, you're fine as long as your home meets the criteria they're looking for. If you're in a high fire zone area, you probably have to go to something called the California Fair Plan. And there is nothing fair about the California Fair Plan. The California Fair Plan is a program where all insurance companies have to come together and equally participate in protecting homes that are not able to get insurance from any one particular insurance carrier. That sounds like a good thing, but the rates are crazy high. So if you're looking to buy in a wooded area, in a forest, near an area that is considered in the maps as being a high fire zone at all, there's a really good chance your insurance is going to be significantly higher than what I'm quoting here. Your realtor is going to know that. Your realtor is going to have a feel for the market. The other thing is brand new homes come with significantly higher property taxes. Now, the homeowner's insurance is usually cheaper because they're new and they've been built with more stringent fire codes and they've got sprinklers in them. And so you can get insurance for a lot cheaper. The trade-off is you're often paying significantly more in property taxes. And so the amount that you're pre-approved for, if you're not clear with me and with your realtor of what you're looking for, may be leading you down the wrong road. And this has nothing to do with interest rate. Even though I've been talking about the impact of interest rates on your approval amount, the truth is all of these things can change. And so it's important that you stay on top of it by staying, first of all, connected to me. Keep watching these videos like you're doing. I'm going to keep educating you on this stuff, helping you know the things that you need to think about and need to be aware of. Another thing you need to be aware of is flood insurance. There are homes that are in flood zones that require flood insurance. And that flood insurance has to be included in the monthly payment. So that's part of the money that we're going to be looking at to say, hey, you can only qualify to this dollar amount in a monthly payment. But we got some other pieces that added to the other costs. So now the only way to get you within that number is to lower your principal and interest payment. Well, guess what? Principal and interest payment is a factor of your loan amount, which the state will not let you put more than 5% as a down payment, or it's a factor of your interest rate. So this is where interest rate buy downs come in. Now, I don't have a chart showing this. At some point down the road, I'll have a chart that better explains interest rate buy downs. But I want you to bear with me to understand the concept. If today's rate is 7.25%, and you've got a monthly payment, obviously at 7.25%, it is $4,562. You can buy down that interest rate. So I'm actually going to let's do it here. All right. So you got a rate at 7.25%. So this one, I'm going to start at 0. Actually, I'm not. I'm going to bear with me for 1 second. I think I can do this pretty quickly. Equals payment at the interest rate, which is going to be that one divided by 12. And then it is going to be the number of periods, which is 360. And then it is going to be the present value, which is the loan amount, which is going to be here. But I don't want that one to change. So let's put this in here. Okay. And that is it. And then I'm going to do that times -1. You get to watch my program spreadsheets. Isn't this fun? Didn't you show up here to watch my program spreadsheets? Okay. 3170, principal and interest. I should have done times -1. There we go. 3170 in principal and interest. Now, if I do this, if my magic works the way I expected it to, and let's make this a dollar amount. So at the same loan amount. So all 4 of these are based on this particular loan amount. Okay. So if you are buying a $533,000 home and today's rate is 7.25%, then you have the option to say, you know what, John, I got a problem because I have flood insurance. It's going to add an extra $100 a month. How do I save $100 a month? Well, you save the $100 a month by buying down your interest rate to 6.75, because 6.75 is $157 a month cheaper on your monthly payment forever. Now, this is what's called a permanent buy down. I don't believe permanent buy downs are a good idea for you. Let me say that again. I don't believe permanent buy downs are a good idea for you, because I don't believe you're going to keep this loan, for a significantly long enough period of time to make sense. So if I said I'm going to save you the $157 a month, and it's only going to cost you, $1,000, well, darn, that's a really good deal, because just in the first 6 or 7 months, you're going to save enough money to pay back that $1,000. But if I said it's going to cost you $10,000, well, I don't know if that's as good of a deal anymore, because paying $10,000, sure, over the life of the loan, if I save that money, I'm going to save $157 a month. Let's use my calculator here. I'm going to save $157. Come on, calculator. Can you actually show up for me? Everybody's root on the calculator. Okay, calculator, congratulations for showing up. So I'm going to save $157 a month. Okay, but it cost me $10,000 in a buy down. So $10,000 divided by 157. Oops, let's do that again. Let's clear that. Okay, $10,000 divided by $157 saved takes you 5 years to make back that money. 5 years. Do you think you're going to keep this loan for 5 years? Is it worth spending an extra $10,000 in closing costs? Now, I'm not telling you it's $10,000. I'm telling you there's a number, and that number changes every day. Talk about confusing. That number will change every day, and CalHFA doesn't publish that number. So you're going to say, John, can I buy down my interest rate? Yes. Cool. What's it going to cost? I don't know. It's the day we lock. And so on that day, we call CalHFA and we say, hey, are you allowing buy downs today? And they said, yes. Cool. How much are you letting us buy down? I don't know. How much do you want? It seems like it's kind of a Abbott and Costello skit. But the truth is, they are calculating what they're going to charge to give you a certain lower interest rate. And so you have to then say, well, am I going to keep the loan that long? But there's one situation in which it doesn't matter about how long you're going to keep the loan, and that is, can I qualify? Because if the only way you qualify for the price you went into contract is if you're at 6.75, and today's rate is 7.25, and you have to save that $157 a month in order to qualify, then you don't have a choice. You need to pay that. And we can take that out of your Dream for All money, which kind of means that you're borrowing more money. Or if you have your own money for closing costs, it just adds to the amount of money you're paying for closing costs. But it's a way to make the numbers work. That's the only time that I'm going to recommend that you do a permanent buy down. Other than that, rarely should you be doing a permanent buy down. All right, so we got a question. Let's see what our question is. Hey, Nikki. Yeah, you're probably going to refinance it in 5 years. Exactly. Like Nikki's got it. It's not worth spending the money because you're going to refinance within 5 years. So thank you, Nikki. And you got to see your name in lights. So that's the point. The point is it's not worth spending that money. So we will run a calculation. If you need to do a buy down, I'll run the calculation because that's just what is necessary. But in most situations, it takes between 4 and 7 years to break even on the buy down. And I don't expect you to keep this loan that long. You're probably going to refinance one time without having to pay back Dream for All, which, by the way, there's an argument that we pay it back early. There's an argument that we don't. Talked about that a little bit at the beginning of this call. But the fact of the matter is, you have to know that a permanent buy down isn't likely to pay off. So now everybody says, well, what about temporary buy downs, John? Maybe I can do a temporary buy down to get my payment lower so I can qualify for that higher price. Temporary buy downs don't count towards qualification. So what's a temporary buy down? A temporary buy down says, hey, if we're going to, let's say your rate's at 7, and actually, let's just do this really quickly because this will make it way easier. If I just do this the rest of the way, love it. And let's look at, okay, so let's pretend it's today's market and rates are at 7.25, which means today's rate is, or today's payment is right there. But you're going to do a 2-1 buy down. So that means that the first year, you're going to have an interest rate 2% lower. So that means that your interest rate is going to be at 5.25. Okay, I got to add one more line. All right, let's see here. Move this down here. Insert, copy all of, I should just be able to do that. And call this 5.25. Nope. 5.25. There we go. All right, perfect. So at 5.25 for your first year, your principal and interest is going to be that number. And for the second year, your rate's going to be at 6.25%. This is what a temporary buy down does, which means your payment is going to be that number. Okay. So in the first year, you're going to save that minus that. You're going to save $603 a month. That's a steal. I save $603 a month. I am doing it. Okay. In the second year, you're going to save that minus that. So in the second year, you save $308 a month. But here's what it's going to cost. It's going to cost equals that times 12. And the same thing right there. So your grand total cost is going to be $11,000. You're like, John, that's great. You told me it was going to be $10,000 to buy down my rate. It would save me $153 a month. It would get me from 7.25 to 6.75. And it would save you $153. I'd rather spend that 10 grand, saving myself $600 a month the first year and $300 a month the second year. So there's a couple of caveats here. First of all, this money must come from the seller. The seller must give you a credit. So it's called a 2-1 buy down, and it must equal seller credit. Has to be this number right here. Oops. And 222. Perfect. So 2-1 buy down, you got to get a seller credit of $10,000, $10,953. So you're saying, hey, Mr. Seller, hey, can you give me more money? Can you give me a credit? Well, if they were willing to give you a credit, they could give you a credit to help pay for some of your closing costs. Now with Dream for All, the fact is you can include your closing costs on the loan, but the seller credit is not free money. It's money that you would have gotten otherwise, that you could have taken off the price of the home, that you could have taken off of the closing cost credits. You could have used it in any number of different ways. By the way, here's one more thing to understand. Well, I'm going to postpone. I don't want to confuse multiple issues. So let me just say this. A temporary buy down gives you a lot of bang for your buck, but it's temporary. Now, the reason I love temporary buy downs, if you really have a situation where, John, I can't manage this payment right now because I've got student loans and car payments that are going to be gone in a year, but I need to focus some of my money over there. Then a 2-1 buy down is a great idea because it lets you have a lower monthly payment and have a smooth start into home ownership. But kid you not, this payment is still $31.70 a month. We're just taking some extra money from the seller and pulling it out of that bucket and helping pay your mortgage payment every single month. So it helps you feel like it's a lower payment, but it's really just a bucket of money sitting there. Now, the cool thing is if you refinance after a year, you've spent this $7,200, but there's still $3,700 sitting in that temporary buy down account. That money belongs to you. So at the end of the first year, when you refinance, if you refinance at that time, then you have a credit paid against your principal balance that lowers your balance so you don't lose a penny of that money. So guys, I've covered a lot in this screen, and I just want to help you understand that these are the things you need as a great lender to guide you through the process. Should I do a temporary buy down or should I not? Should I do a permanent buy down or should I not? When should I refinance? How do I make sure that nothing goes wrong during the process? These are all critical, important questions that you have to make sure you have the right representation, the right people guiding you through the process. All right, so I've got a question. I'm about to wrap up. So if you have questions, now is the time to post them. So Jay Holiday gives us a question. If for some reason the Dream for All money for if I use some of the Dream for All money for closing costs, that would make it less than 20%. Would there be PMI at that point? That is a great question. The answer is yes, like for sure, yes. But what I have done in the past for my clients that bought last year is we prepaid the mortgage insurance as part of the closing costs. And so it makes the closing costs, if you have great credit, might be about 0.5% extra in one-time fee, but it keeps your payment exactly the same. So it gives you flexibility that says, hey, I can have a little bit less out of pocket. My payment stays the same. I just have a little bit higher closing costs up front. That extra 0.5% isn't going to be very painful, and it keeps your budget exactly the same. So in that situation, to kind of keep things simple, that's my recommendation is, hey, if you don't want to come up with the money for the closing costs, that's fine. Then we're just going to make the closing costs a little bit higher since we're already in that category. And we're going to use that money to prepay the mortgage insurance so that you never have to worry about paying PMI. So Jay Holiday, that is a fantastic question, and I really appreciate it. All right, guys, let's see if I have anything else that I did not cover. So what do we do now that we've registered? You pray a little bit, maybe, you know, kind of start making sure that you pay your credit cards on time. I'm kidding. I'm not kidding. Pay your credit cards on time. But there's nothing to do. Okay. Once you have your registration submitted in the portal, you wait. And Cal Haffa has said they have no idea when they're going to be able to tell everybody. So it's going to be stressful. But in the meantime, do the things we've talked about. Start figuring out who you want to hire as a realtor. If you don't have a good realtor or you don't know who to use, give me a call. I've got amazing realtors all up and down the state that I can connect you to. Okay. And really start thinking about, what do I want to find in a home? What concessions am I willing to make? I see your question. Somebody has a question here. Nikki. Here's Nikki's suggestion. Check the website 1,000,000 times a day. That actually is a really good idea. Don't crash the website, Nikki. I will personally blame you if the website crashes. But check the website because you also don't want to miss if they ask you a question. During the review period, if your name is brought up as somebody who was picked, but the auditor, the private investigators come up with an issue, they're going to email you and they're going to say, hey, we need you to respond in a short amount of time to help us prove if this is true or not true. You only got a short amount of time. They haven't said how long it's going to be, but you don't want to miss that window. So check the website. Make sure that you don't miss that. Tiffany says, thanks for all the information. What website can we check? It's actually the same website you registered on. And so you're going to go to, let's take you there. If anybody has not done their registration yet, you're going to go to Cal Haffa's website and you're going to go right here. Same place you registered, but just as a way to tell everybody, right here, Kathy, I saw your question or your statement. I'll bring it up here in a second. So you're going to go right here. And you're going to go to California Dream for All Home Buyers. And then you're going to go over on the right side here. And you are going to click register for a voucher. And what it's going to tell you is the ability to log in. If you have not registered yet, this is where you register. If you've already registered, and it looks like it's slow tonight, you're going to go log in and you're going to log into the account. Okay. I don't know if I can log in right now. I got a fake account going. I won't finish it, but I did it for kind of my testing. So once you're in here, it's going to say what your status is. Yep, I'm in here. So my status is saved incomplete for Test Smith. Okay, first name Test, last name Smith. But it's got my contact information. Anyway, so this is right here where you're checking to see, and then you'll be able to see right here under, my understanding is it'll show under application tasks. So you're able to see right here if you have any tasks that are assigned to you, and then here's where you review documentation. So I'm assuming if they have a letter or an email, they'll upload it into here. I don't have a lot of clarity on what that's going to look like. I do know 100% that you're going to see your voucher status right here, and it's going to say something like additional information requested. So that's a really, really good question. Kathy says it's going to be different in this business very soon. So Kathy is a real estate agent. Kathy, I think there's a lot of changes coming, but I think that we don't know what they're going to look like until they get here. So guys, just stay tuned. There's a lot. It's a time of turmoil for realtors and for the market and for buyers and for sellers and for everybody involved. Right now, it's business as usual, but just understand people are already starting to change how they practice business. Sellers are starting to kind of test the waters to say, hey, do I even have to pay a realtor's commission? Because if I don't have to pay it, I won't. Now, don't believe what you read in the newspaper, because what's a newspaper, by the way? Whatever. Anyway, don't believe it's the gray hair. See, I was around when newspapers were around. But don't believe what you're reading on a blog or on a website or whatever you young whippersnappers say. By the way, if you know what that is referring to, the young whippersnappers, then you are of the same era I am. Anyway, the fact of the matter is, and Kathy's saying it, buyers are asking me right now. People are asking these questions. Hey, is the seller going to pay for my commission? Do I have to worry about paying that money out of pocket? Fannie Mae came out today and said it's okay for a seller to pay your commission, the realtor's commission, and we're not going to count it as part of the maximum credits the seller's allowed to give. But that doesn't mean the seller's going to give it. That's the key thing, that you have to get connected with a great real estate agent who's going to help you understand what is the local market doing, and it's going to be shifting. So you want to listen to me. You want to listen to trusted people that are local, that understand what's happening in the market that you're in. If you're in a highly, highly competitive market, I talked to a client today who wants to buy in the San Francisco Bay Area, in the East Bay, Alameda County. And she said it's a highly competitive market, and it is. And I think that we're going to end up seeing sellers saying, I'm not willing to pay any buyer's agent's commission. Well, now the question becomes, how do you pay for it? Am I allowed to wrap that into your closing costs as part of the CalHFA loan? There's limits on how much there's too much for me to say, for me to worry about right now. Okay. There's a lot of, I understand how all this stuff works, and I have a lot more questions than I have answers. So I'll leave it at what Kathy said, which is pay attention and keep your eyes open, but just recognize first-time home buyers, existing home buyers, move-up buyers and sellers, they're going to have to function in the market going forward. We're going to have to find a way for it to function. You're going to be in the middle of the test period. You're going to be looking for a home and buying a home at the time when the market is in the middle of changing. And so you have to be nimble, and you have to pay attention and see how this is going to play out. But the bottom line is, I'm here to guide you. Great realtors like Kathy are here to guide you. And all I want is to really make sure that you have the right representation, and that you don't make bad decisions based on inaccurate information. So the thing I was saying about reading on a website and a blog, and I kind of got offsite here, newspapers, is the newspapers will tell you that, hey, the seller might not pay your commission, your realtor's commission, but that means you'll get the house at a lower price. I don't see it. By the way, thank you, Kathy. I appreciate that as well. So I don't see it. I don't see sellers saying, okay, so I'm selling my house for $800,000, and I normally was going to pay $25,000 to a buyer's agent. But now that I don't have to pay that, I'll go ahead and sell it for $775. They want the most amount of money they can get. Okay. It's like going to your employer, and your employer says, you go to work one morning, and your employer says, hey, I heard that you got some tax credits, and that you don't have to pay as much in income taxes on the employer. You had another kid, you got 2 more kids, and you got twins. And so you got bigger tax credits. And so because you got these bigger tax credits, you don't actually have to pay as much money to the IRS. So I'm gonna lower your pay. I'm gonna give you less money because you don't have to pay as much money in taxes, and therefore it equals the same, and I win. That's not what happens. And that's not what's going to happen when a seller goes to sell their home and the realtor says, hey, you don't have to pay the buyer's agent's commission. The seller's not going to say, great, then I'll sell it for 3% less because that's only fair for me to lower the price so the buyer can use that money to pay for their own agent's commission. That is not what's going to happen. Now, in highly competitive situations, you're going to have to figure out how to cover your own buyer's agent's commission in order to compete. And that's one of the ways that you compete. There's lots of other things you can do to make your offer competitive. And that's what I'm going to help guide you through the process. So guys, please, if you haven't subscribed already, please subscribe. Get a copy of my ebook. This also puts you on our distribution list to get regular updates from us. So if you have not already gotten a copy of the book, download it. I don't care if you read it, but download it. It subscribes you into our update portal. And we're going to send out regular updates about all of these things and keep you informed throughout the home buying process. So gang, thank you everybody for listening to me. Remember the most important thing, you literally have 2 weeks left, okay? 2 weeks left, that's it. 2 weeks from tonight, 5 p.m., and it is getting busy. So going forward, I'm not gonna have as much time to give advice. Going forward, my focus is gonna be giving out letters. And so for those of you who have not applied yet, get started now, get your application in. We might just have to give you a letter so that you can get into the portal, and then we will meet, you and I will have a meeting after the portal closes to talk about strategy, to talk about what price point you want to be at and whether you want to put closing costs out of your pocket or not. So the letter might not reflect the exact dollar amount you were hoping for, but as we get closer and closer to the deadline, my focus is to get out as many letters as I can to those people that need a letter to get in line, okay? And those of you who applied early, you had a lot more of my time, a lot more of strategy and advice. Those of you who are applying now, you're going to get the same strategy and advice, but it's likely to come after the portal closes because right now my time is going to be spent figuring out how to get you pre-approved. I know once you get your letter, you're like, John, I don't care about everybody else. As a matter of fact, you can stop rushing to get them done and give me time to talk about my options so that that's one less person I'm in competition with. That certainly is one way to look at it, but let's be real. We all want to win this lottery. And the way to win is crossing our fingers and saying a prayer. It's not about trying to trip the other guy as he's headed to the finish line ahead of you. So let's all get along. Let's all play safe or fair in the sandbox. All those fun little sayings. Bottom line, gang, I'm looking forward to guiding you. I'm having a great time guiding you, and I look forward to continuing to be your guide. So if you have questions about anything, reach out to me. If you have friends or family that you think might benefit from this program, send them a copy of the ebook as well, and I look forward to taking great care of you. Have an absolutely wonderful evening, everybody. I will be back again next Monday night with my final live stream, and then I'll be doing regular video updates that will not be live streams, maybe periodic live streams, but my weekly live streams end in next week because the following Monday it's closed by 5 o'clock. 2 weeks from today, 5 p.m., we're done. Hey, everybody, have an absolutely wonderful evening, and we'll talk to you soon. Bye-bye.